Let's start with markets news. The S&P 500 closed above 5,000 for the first time ever today. The index also notched its 10th record close of the year. Stocks have been propelled higher in recent weeks on strong economic data and cooling inflation.
Capital development, the motivation for innovation, the drive to work harder, and the efficiencies of the free market are all touted as major benefits of capitalism. Benefits which have in turn made our civilizations thousands of times wealthier than they were in the centuries before capitalism. People that oppose capitalism will point to rising inequality, the exploitation of natural resources, and the erosion of human rights in the name of maximising output as equally important drawbacks. Unfortunately, these opposing ideals mean that support or criticism of the predominant economic system in the world is treated less as something to be optimised and more as something to align behind, as if capitalism and something like socialism were opposing sports teams where only one side could win.
So I've been working on the spreadsheet to more efficiently track, as you can see here, my dividend income, the value of my portfolio, visuals on both those metrics. But then this part here are mock portfolios. Each section is a different variation of my portfolio. And the point of this is to just benchmark it against the S&P 500 and see how my portfolio stacks up against it. So example, for each of my holdings, I can see today's price movement of 1%, 0.68%. And then in the column to the right of that, I have the overall average for the portfolio given the weight each holding represents. So that allows me to, on a day-to-day basis, see how I stack up against the market. If I'm more volatile, if I'm more conservative, all those characteristics should give me that insight into my portfolio. And then to the right of that column, we have the same thing but for the 1-year view. And comparing that against the S&P 500, all three of these portfolio variations do outperform the S&P 500 over that time period, while having a much higher yield, about double that of the market, which is my overall goal. A lot of people ask me, what's the point? What's my strategy here? And it's kind of an all of the above strategy. I want to have a growing stream of passive income with competitive total returns with the rest of the market. And I think these portfolios do a pretty solid job at capturing that. So far, I have 1 month of income data on this portfolio in the new year, and it came in at just shy of $200, $199. And looking back over the previous 3 years, that is by far the highest. So that's super motivational. We can see that in total, 2023, my portfolio income was $2,102. I'm hoping this year it's closer to, let's say between $2,500 and $3,000. And with the portfolio value we're currently sitting at, or we were sitting at the end of January, $83,076. To help me track this a little bit better, I have the year-over-year change, which includes my deposits. So that's why these numbers are so high. We can see that in 2023, my value year-over-year increased 90.72%. But that was with nearly $27,000 of net deposits. If we factored that out, the portfolio had a return roughly of 19.18%. So that's some more data I recently added, and I think it gives me a bit more insight into my portfolio. Now, another tool I really like and I spend way too much time on is Portfolio Visualizer. I guess I'll leave a link in the description. But this allows you to backtest various portfolio combinations. It allows you to test 3 portfolios at a time, benchmarked against whatever you want. Of course, I benchmark against the S&P 500. And these 3 are some of the best I've been able to come up with so far. And we can see here that in particular, blue is the most volatile, growthy, so it goes up and down the most. And it also generates the most income, which is usually not what you see. Usually the more conservative, less volatile, the more income it generates. But I was able to come up with these characteristics by a fairly simple split. We have 50% in SCHG, a growth ETF, and then 40% in QYLG, Here I have it split up into QQQ and QYLD 50-50 because this has a longer history than QYLG and it's essentially the same thing. Now QYLG in terms of the holdings is almost identical to a growth fund like SCHG. The big difference is just the partial covered call strategy. And you guys know that covered call income is directly correlated to the volatility of the underlying holdings. It's why a growth-based covered call fund actually has the potential to generate more income than a more conservative dividend-based covered call strategy. So that's why it generates a lot of income and is the most growthy. So that was a quick peek into my now $200 per month dividend portfolio. I did film the video a little bit differently. If you enjoyed it, let me know by leaving a like, subscribing, and I'll see you guys in the next one.